Good morning. Today is Monday, March 20th, and this is the ADMIS Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADMIS Investor Services or Archer Daniel Midland Company. Today's guests, Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Alan, the NASDAQ futures advanced to new historical highs last week. Traditional thinking is that any time the Federal Open Market Committee increases interest rates, stock index futures usually decline. Why have stock index futures held up so well in the face of tighter credit from the FOMC?
Okay, well, it's true that anytime the Fed does raise interest rates, there tends to be pressure on stock index futures. But in this case, interest rates are still low enough to sustain the bull market. So even though there was a rate increase, and there are likely to be more rate increases this year, interest rates are still low enough that it will not be an impediment to the bull market. So more strength is likely for all of the indices across the board, and this is a trend that should last for many months.
The U.S. dollar has underperformed the news lately. Why is this the case? Especially since the Federal Reserve hiked its Fed fund rates last week, which is supposed to be supportive to the greenback.
Exactly. Anytime a country raises interest rates, it tends to be supportive for their currency. But in this case, the rate increase was very much factored into pricing. And in addition, we are seeing other central banks around the world who had been accommodative are likely to be less accommodative in the near future, such as the European Central Bank that is likely to back away from its accommodation. Even the Bank of England is likely to raise interest rates next year. So the interest rate differential advantage that the dollar had enjoyed for quite some time, in fact last year the dollar advanced to a 14-year high because of the interest rate differential advantage that it had, is no longer there. So we are now thinking that the dollar index has topped out as interest rates tend to converge, we think, globally.
Why did gold and silver futures advance immediately after the FOMC increased its Fed fund rates targets by 25 basis points at its policy meeting last Wednesday?
Okay, there again, a rate increase tends to be bearish for precious metals. But in this case, since the rate increase was totally factored into pricing at the time, it did not have much of an impact. But what did have a positive impact, a very bullish impact, was the fact that the Fed in their statement indicated that they would probably raise interest rates only 2 more times this year. There was some talk that the Fed could raise as much as 3 times. So a measured pace of rate hikes from the Fed was taken as a very bullish development for the precious metals, and we continue to believe that the bull market is intact, and I think within the next couple of months we'll see new highs for both gold and silver, including an advance above the recent high of 1265 in the gold.
Okay, thank you, Alan. As far as the grains are concerned, there's 4 issues that the markets will be focusing on. Number 1, the funds last week sold more soybeans, soybean oil, corn, and wheat futures than was expected. And we think that this might continue, especially in the soybean complex, because of the record South American crop. Brazil's harvest is about 70 to 75% done. They continue to talk about record yields, and now soybeans will be coming on to the market. Also, on March 31st, USDA will estimate acres and stocks as of March 1, and we think that soybean stocks will be ahead of a year ago. Also, today's the first day of spring, and last week the National Weather Service came out and said that we would probably have a warm and wet 30-day outlook. It's going to be raining here in Chicago all next week. And then that, as far as the spring is concerned, we'll have normal to above temps and maybe normal rain. So we'll see if that causes any delays in planting of the corn crop. Certainly farmers will take the moisture for later on. Their summer outlook called for normal to above temps and normal to below precip, so they see if that impacts final yields. Also on March 31st, the USDA is expected to show lower corn and wheat acres. We'll see if that offers some support. In general, we're probably in a trading range in all three markets and looking at somewhere around 990 as key support. If you take that out, we could go down to 960. 1020 seems to be a level of resistance that we hard to push above because of the big South American crops. In the May corn, 360 to 372 might be the trading range until we know more about our stock situation, what the farmers are going to do, and what kind of weather we're going to have in 2017. And in wheat, a fairly broad range between 428 and 445. It's still too much wheat in the world, but we'll have to see what kind of crop we have with the lower acres and maybe a little bit of dryness in the western part of the southern plains. Thank you for this watching this video today. Remember, the views and opinions expressed today on these videos are solely those of our guests and should not be construed as the views or opinion of ADMIS Investor Services or Archer Daniel Midland Company. If you would like more information about our brokerage service, would like to speak to one of our experts about managing your risk, or would like to open up a trading account, please visit www.admis.com.